have an exciting presentation today. We're going to walk through the entire investment thesis behind Diamond Standard and really the world's first and only diamond commodity, which really makes investing into this entire asset possible for the very first time. We're going to wait a couple minutes. I know we have a lot of people signed up for this, and we have a lot on so far. But give us a couple minutes and let a few more people join, and then we'll start. Thank you. Okay, let's go ahead and get started. Welcome, everyone. Again, I'm Cormac Kinney. I'm the founder and CEO of Diamond Standard. What we're going to talk about today, and this is live, if you're wondering, is Diamond Standard Commodities, and in particular, the Diamond Standard Fund, which we launched last week. It's already been a significant success. We've got a lot of subscriptions in our first few days. And the reason is simple. This fund makes it possible for a much larger set of investors to access diamonds as an asset. So first of all, let me just start from the very beginning. In fact, I'm gonna stop sharing the slide for a second. The foundation of everything that we're doing is based on these. These are the Diamond Standard commodities. We have a coin and a bar, and if you look closely, you'll see that there's diamonds in there. And the breakthrough is using computer science and radical transparency. We are able to prove that these two bars, for example, are equivalent. They're not identical. The diamonds in every bar are a little bit different, but they end up in here through a computer science process using automated market making, statistical sampling, and optimization, so that every bar contains a group of diamonds that add up to a public standard. This wasn't possible even 5 years ago because all of the technologies that are needed, the computer power, the optimization, and the blockchain, which makes everything public and permanent, really weren't available and possible. But now that you have a commodity where every bar is equivalent, you can, for the first time, have a spot market where people can trade this commodity, and when a small number of bars trade on a daily basis, we have a market price. That market price can be used to value anybody else's asset when it's sitting in their vault. It's called marking to market, and it's really what's required for any kind of professional investment firm or fund to hold an asset. They must be able to mark to market that asset, and the Diamond Standard coin and bar make that possible. So much so that we now have approval to deliver these coins and bars to settle futures contracts on the CME, which is something that we expect to launch later this year, although we already do have approval. The entire production of Diamond Standard is done under regulatory supervision by the Bermuda Monetary Authority, and then everything we do is also audited by Deloitte. So they actually confirm the optimization and the offerings, etc., that we can do. So what we're going to talk about today is the newest vehicle that enables us to bring this product to the market, and that's the Diamond Standard Fund. The Diamond Standard Fund is a joint venture between ourselves and Horizon Kinetics. Horizon Kinetics is an extremely respected asset manager. They operate mutual funds and ETF and private funds for about the last 30 years, led by a gentleman named Murray Stahl, who's an influential contrarian investor. And they manage about $8 billion. Most recently, they launched an ETF on the New York Stock Exchange last year, and they've raised about $1.4 billion for that fund, which is designed to protect against inflation by investing in companies that often do well in periods of inflation. So they're the co-sponsor of the Diamond Standard Fund. And by putting these commodities in the fund, and that basically all the fund does is hold coins and bars, but by putting them into a fund, we make it very convenient for investors by providing the custody, the trading, we also provide auditing. We have a third-party auditor called Witham, and also the administration. We have US Bank as an administrator. But by putting this asset into a fund, it makes it accessible to investors that cannot buy commodities or don't want to bother managing physical commodity positions. But most notably, IRA accounts and 401ks cannot buy diamond commodities, but they can buy shares, or in the case of this fund, units. And also investment managers who run funds generally don't have a mandate that includes commodities, and RIAs and investment wealth managers, they don't generally offer IRAs to their clients. So you can read about the fund on our website. It talks about the fees, which are 2%. We expect these shares to be tradable on the market in the near future, and it has weekly creation and redemption. So you can read about all of the details of that fund. What we want to talk about, though, is the investment thesis. What we think are the reasons that this is a good investment. And it really comes down to one core thesis, which is that diamonds have been around forever. The pirates of yore would try to steal the diamonds from each other, and the Queen of England and the Maharajas of India always loved diamonds as a treasure. But diamonds were never available to investors because every diamond's a little different. You could not mark to market. There was no price discovery, no transparency. So an investor simply couldn't hold a diamond because they would never know what they're worth. And when they wanted to sell them, they could never get a good market price. We believe that the commodities make this asset accessible and that it unlocks a $1.2 trillion asset for the first time. Natural resources are really an important asset to have in your portfolio because they're a hard asset. They're deliverable. You can see them and hold them and take them, versus a share or a bond where you're relying on somebody else, a sponsor, to pay the interest or create value for the shares. The hard asset is the value. Historically, diamonds in particular, among all other hard assets, have extremely low correlation. And we think that because they're being acquired for the very first time as an investment, that diamonds have a unique potential to increase in value. The reason we think that is that we compare diamonds to gold, silver, and other precious metals. This chart on the right shows the last 20 years of diamond prices. And as you can see, versus gold, gold has gone up 500% over the last 20 years. A lot of people don't realize both gold and silver have significantly outperformed the S&P 500 over that long range of time. The reason we look at 20 years is that 20 years ago, the first gold ETFs were launched, starting with State Street's GLD. That precipitated the financialization of diamonds, made them much more accessible to pensions and endowments and every other type of investor who wanted the exposure to gold, but aren't necessarily gold bugs that want to hold it in their basement. Diamonds, you'll see at the bottom, the purple line, were essentially flat for the last 19 years. The last year, since late 2020, you'll see there's been a inflection point, which is interesting. But this seems to indicate over 20 years, diamonds have about 5x return potential compared to gold. If they were to catch up with gold, they would go up 5x. We'll see if that happens. Obviously, there's no way to know. However, if you look at the last 18 months, which is the time frame since we received our regulatory approval, diamonds have returned 45%, significantly outperforming gold, very, very significantly by over 25%, but even outperforming the S&P 500, especially recently, where the S&P has started to fall fairly significantly. What we see in this pattern of the purple chart for diamonds are two factors. Number one, COVID happened during this period, and a lot of the diamond mines were forced to close due to outbreaks or to protective measures. But in the meantime, you had a lot of consumers sitting at home, unable to travel, unable to go out to restaurants, but they were able to shop online. And so over the last 18 months, jewelry has actually had some of the best years ever, actually outperforming their sales in 2019, because people continued to buy jewelry and the diamond supplies were diminished. Still, with that rise in diamond prices, they're still well below the high prices that they achieved in 2011 and 2012, where diamonds were about 50% higher or 25% higher than they are right now. This is kind of the foundation of our outlook. If you look at every precious metal, gold, silver, platinum, palladium, rhodium isn't on this list because it doesn't have futures, but even rhodium, investors own at least 15% of the above ground supply of each of these precious metals. Why? These investors use them as a store of wealth. Again, an asset that's not somebody else's liability that they can have in a vault, often through an ETF, but that asset they know has its value. It will have its use in the future if they ever wanted to liquidate it. They know it can't go to zero the way a stock can. Secondly, they hold them as a hedge. Commodities generally do well in periods of inflation. Hint, what we're seeing right now. And also diamonds can be, or commodities in general can be a speculative investment, certainly through futures and options. Diamonds, though, compared to palladium, only 1% of the world's diamonds are held by investors. We're not counting all the jewelry that people own. That's not an investment the way a bar of gold is, or a futures contract, or an ETF is. We believe simply that now that we've created diamond financial products, that they will catch up with palladium. And what that means is 15% of the world's diamonds will be acquired by investors. We're supporting that progression by doing exactly what we're doing now. We've just launched a fund. In the last 18 months, we've launched 2 spot products, the coin and the bar. Those products are already consuming significant numbers of diamonds and probably having some impact on the price. In the near future, I've already mentioned the futures on the CME. We're also launching options on the MIAX exchange, and we're in the process of developing ETFs. We've actually already filed an ETF in collaboration with the New York Stock Exchange that will list under the ticker DIAM, but that will take some time before those launch. In the meantime, we'll probably launch an ETF in Canada in the short term. But all of these different products open up a new segment of investors to giving them access to diamonds. The ultimate inflection point, in my opinion, will be when diamonds are added to the commodity indices. Diamonds are not in any commodity index now, like Goldman Sachs or Bloomberg or S&P. But based on their trading volume, at some point, they will be added to all those indices, which will trigger purchasing by a lot of investors, especially pensions and endowments and sovereign wealth funds that very often allocate 5% to commodities broadly. And what that means is they allocate to the index. So once the index adds a new commodity, which is pretty rare, that commodity gets acquired by thousands and thousands of funds, essentially simultaneously. So we talked about the price history. I mentioned the correlation. You may not know my background, but before Diamond Standard, I ran a large quantitative portfolio for Tudor Investment Corp, Paul Tudor Jones, and Millennium. So I have a lot of experience with stat arb and correlations and market trading in general. I've built over 100 trading systems. I've never seen an asset that essentially has a 0.0 correlation to its peers. Over the last 20 years, diamonds have been 0.04 correlated to gold, to silver. That's incredible. A 0.0 correlation to stocks, a 0.1 correlation to bonds. Actually, diamonds have been most correlated to Bitcoin over the last 20 years, although Bitcoin hasn't been around that long. The lack of correlation is extremely important, especially to institutional investors, where uncorrelated positions increase the Sharpe ratio. They reduce the volatility of the portfolio. Having an asset that's uncorrelated to everything else is almost never happens. And even over the last 18 months, that lack of correlation has continued. Diamonds have had a negative correlation to gold because gold has slightly gone down while diamonds have gone up. So I mentioned this really for institutional investors, but I do want to note, I expect that correlation to increase over time. As we financialize diamonds, create the ETFs and the futures, liquidity tends to cause things to become correlated. And so we expect that correlation to go up, but right now it's extremely low. This is a big part of the thesis. We are absolutely entering or in a commodities super cycle. This is when you have a compounding effect, often driven by inflation, where commodities start to go up, core commodities like oil or food, and that causes the cost of everything else to go up. And a super cycle is generally 10 to 20 years, sometimes longer, where commodities trade at a higher than their moving average for an extended period of time. Last year, the Goldman Sachs Commodity Index was up 40%. And this last month, or in March, we hit what was then a peak inflation. Accelerating inflation hit 8.5%, which is the highest level since early 80s, I should say. With diamonds are now becoming more of a market traded commodity. I think you have two super cycles combining together. The normal commodity super cycle, where just the cost of everything goes up. Diamond mining uses a lot of fuel, for example, all the machines, the trucks that move all the granite to crush it, etc. That uses power, uses electricity. That expense is going up. The cost of diamond mining is going up. The second super cycle is what we've talked about with investors accumulating diamonds for the first time. That compounding of demand is something that I think will be very unique for diamonds. The other thing that's unique about diamonds is just how dense in value they are. The diamonds inside the coin and bar, if you were to get rid of the plastic that provides the authentication and security, These diamonds are $1.1 million per ounce. 1.1 million. Gold is only $1,900 an ounce. So diamonds are dramatically more value dense, which means you can move a lot of value very efficiently. Their cost to store and transport is dramatically lower than it is for gold. You can decentralize diamonds. You can put them in your pocket and move them with you. That's unique among any other natural resource. So let's now talk about the demand for diamonds. I mentioned during COVID that people continued to buy jewelry. So as we see on this chart on the right, the diamond sales in 2021 were higher than at any point since 2015. And that demand is continuing. It's also global. Every region of the world, diamond jewelry sales are up in the last year. And if you look at the projections of analysts who cover jewelry companies, for example, they expect a 3 to 5% growth in jewelry demand over the next 5 years. For Richemont, which owns Cartier and Van Cleef and other high-end jewelry companies, they expect 7.8% revenue growth over the next 5 years. So jewelry demand is increasing. However, as I mentioned, diamond inventories are near their all-time low. A, because the mines shut down, but B, more importantly, they haven't discovered a new diamond mine in over 20 years. Diamonds are being depleted globally. This chart on the top right shows that decline has been consistent since 2017. And in fact, the projections are that diamonds production continues to decline by at least 2% per year going forward, and then it falls even faster. Last year, they closed the last diamond mine in all of Australia. It used to supply about 12% of diamonds. Now there's no operating mines. The last mines that have been discovered were 25 years ago, and they were discovered in the Northern Territories of Canada. Those mines turned out to be pretty shallow because one mine is already closed after 6.5 years, and the second mine after 11 years. African mines lasted much longer, and certainly the Russian mines. But there aren't any new diamond mines in development, so we don't expect there to be much new supply. What new supply there is actually being found out in the ocean. And right now there are 5 ships. They just launched a 5th one this year that are trying to find diamonds that were washed out to sea over millions of years as a river washed through an ancient volcano. Diamonds are always formed in extinct volcanoes. So they're very different from gold. With gold, you have an elasticity of supply. If gold prices double, they can afford to dig deeper. And there may be less yield per ton, but there'll always be more gold in that region. Diamonds are a pipe called kimberlite where they're formed. And literally 20 yards out of the pipe, there's no diamonds. So you can't just dig deeper. And that's why these mines simply close, because once they're empty, they're empty. The other big impact on supply has been Russia. Russia supplies about 30% by volume of new diamonds. Not by value, but volume. And generally the Russian diamonds are smaller and lower quality, but they're a huge source of supply, about 30%. And now due to the invasion of the Ukraine, the diamond industry has been sanctioned. The CEO of Alrosa, which is by far the largest producer, is been sanctioned personally, and his father is the chief of staff, or was the chief of staff to Vladimir Putin. So they're a very close focus for the sanctions. There are some loopholes, although they don't seem to be very productive so far, because India and China are not adhering to the sanctions. And if a diamond is cut in India, it's transformed according to the customs laws. and that becomes an Indian product. But what we've seen recently is that the Indian banks are not processing payments to the Russian vendors. So there has been a real drop in supply. Yesterday, there was a big article in Bloomberg that the cost of rough diamonds has spiked. And De Beers has said something that we've known for a long time. They have no stockpile. They cannot fill that shortfall, and that we should expect prices to rise. So all of these factors together, most importantly, we have increasing demand for jewelry. We have a diminishing supply of diamonds from the earth, from miners, and we have a brand new demand created by Diamond Standard for diamonds to be acquired by investors. We think that those things are an interesting combination, but it's not the first time we've seen it. A lot of you might be familiar with uranium. And last year, a company called Sprott really brought to market a significant new uranium fund, an ETF traded in Canada. This ETF first was about $1 billion, sold out instantly, and then they raised their cap to $3.5 billion. And that one fund, through its accumulation of the available float of uranium, which is obviously just a small percent, that fund really single-handedly drove uranium up 77% by the end of March of this year. So in less than a year, about 9 months, they drove uranium up 77%. We expect a similar market impact from Diamond Standard, which we kind of can't help. We are buying a lot of diamonds. We bid on millions of diamonds, and we buy and try to buy tens of thousands per week to supply the investment demand. That's brand new demand that we can't avoid impacting the market prices. One solution for that, which will also could mitigate that price appreciation, is we believe that 85% of all diamonds have already been dug up and sold to consumers. And therefore, over the long run, at least, not today, but over the long run, we expect to buy 85% of our diamonds back from consumers. So we're in the process of launching Diamond Standard Recycling, which will buy used diamonds from consumers. And we think it's very interesting as an ESG story because it creates a social dividend where we're buying back really unproductive assets from potentially 1 billion consumers who have diamonds from their great aunt, or maybe they got divorced, or jewelry from the 80s that they can't wear. We're happy to buy that back, extract the diamonds, recycle the gold, and put the diamonds into our commodity. So we think it's a very important ESG story. So the fund, just to finish on that, as I mentioned, the fund is very simply a vehicle which you can invest in, and it does all of the work as far as buying the commodity, providing custody, turning them into a regulated security, providing audit and administration, doing all the tax filings, etc. And you own a share just like any other share. And you can also hold it through your broker. You can hold it in your IRA account. But basically, we take subscriptions on a weekly basis. As long as you provide your funding by Friday at 3 p.m., you lock in that week's NAV, we take your money, and we build new commodities and deliver them to the fund. This fund, we haven't announced it, but I can tell you now, we have an agreement to list the Diamond Standard Index on Bloomberg. That should be coming out in the next couple weeks. And eventually we plan to quote these shares on the OTCQX bulletin board. So that's it. Let me pause for questions and go from there.
Hey, Cormac, I don't know, can you hear me?
Chris, I can't hear you. Is my speaker off?
Your speaker off.
Okay, sorry, go again.
Okay, there you go. Um, while one can invest in specific coins and bars as they must exist to be purchased, will there be enough diamonds to be able to support the massive demand, relatively, of an ETF or a mutual fund based on a commodity store of diamonds? From John McCullough.
Oh, that's investing 101, supply and demand. As demand goes up, if supply doesn't go up, price goes up. And our whole investment thesis is there's not enough diamonds to go around. We have to buy them back from consumers, and that's a lot of friction and time. So the answer is no. We're a brand new giant buyer of diamonds that never existed. And we believe that our buying of diamonds will impact prices fairly substantially. But there are a lot of diamonds out there. Diamonds are worth 1.2 trillion, the above ground, extracted diamonds at current values. That's second only to gold. So there's a huge number of diamonds out there, but we think that the demand of these products, the ETFs, the funds, the futures, we think that will happen first, and there'll be a lag in our ability to source those diamonds. And so we think because of that, this is likely to be a good investment.
Great. We've got, will the fund be SEC registered? If not, why not? From Lawrence Goldstein.
So the fund reports to the SEC. We report what's under a Reg D exemption. So it's an exemption from full reporting initially. However, because it's a private fund, it's not an ETF. ETFs have to be approved by the SEC and file an S1. And there's a lot of other laws and rules regarding public funds. And we'll get to that, but it's not for this fund. We do intend to file what's called a Rule 144 filing within the first 6 months of the fund, which will allow the shares to be traded between accredited investors, and you'll trade those shares through a broker. For example, you can't trade them directly to your cousin. You have to, because someone has to check the accredited investor status. And that's just like GBTC, if you're familiar with the Bitcoin Trust by Grayscale. Those are Reg D shares that became tradable after a holding period. So these shares are identical to that.
How do I buy it from an IRA? What is the process?
So whether yourself or if it's a self-directed IRA, you go to our website, fund.diamondstandard.co, and you begin the subscription process. So you would put in, you're holding it in a fund, and you'll fill out the appropriate forms. Once you are ready to invest, it depends on which fund IRA manager you use. Right now, we're working with Millennium as one example of an IRA platform that supports this fund. And once you sign the subscription documents, Millennium would then wire the funds from your account into the Diamond Standard Fund. But it's all, regardless of whether it's an individual or a fund or a broker, you always start at fund.diamondstandard.co to begin the subscription process.
Any risk of synthetic diamonds undermining value?
Possibly. So synthetic diamonds are real diamonds, but they're just not natural. And any gem lab in most retail stores now have the equipment, can instantly identify a synthetic diamond. So they're not the same. They're chemically, they may be chemically the same, but they don't pass as natural diamonds. And their value reflects that. The value of natural diamonds has basically fallen in half every 18 months. And I've never heard of anybody reselling a synthetic diamond for anything, not even a fraction of what they paid. So they don't hold their value. And as a percent of their value relative to natural diamonds, that's fallen dramatically because natural diamonds have gone up and synthetic diamonds have accelerated down. So we think that they're good. We're glad that synthetic diamonds are out there because we expect that through our demand and the scarcity of diamonds in general, we think diamonds go up 3, 4, maybe 7x in price in the future. And I think that natural diamonds won't be accessible to the clients of Kay Jewelers or Signet, jewelry stores, mall-based jewelry stores. They won't be able to sell natural diamonds. They'll simply be too expensive, and they'll become more of a will become more of a fashion item that you wear like blue jeans and then throw away. Maybe you recycle the gold. So from that perspective, we think there's a substitution effect that synthetic diamonds, once diamonds become dramatically more expensive. But so far, consumers really haven't en masse moved to synthetics. Natural diamond sales have been up. So, I think they're, for fashion, they're great. For investment, they're terrible. And I think the data has supported that. The other thing that's a benefit to us for Diamond Standard is we were very threatening to the diamond industry because we've created transparency and governance. We're regulated, so our exchange is regulated, for example, where we buy the diamonds. And that was scary to the industry, but because of the threat of synthetic diamonds, both of the major gem labs and over 150 of the world's leading vendors have agreed to participate in our activities, either grading our diamonds or providing services or selling us their goods.
Great. I also wanted a question came in from Terry, so thank you, Jim. The next question from John McCullough is, how does the 2% administration fee compare to other funds related to high value commodities? Do you see this falling over time, and how will the fee be paid by the investor?
Yeah, it's a little high, but there's a lot of expense. Most notably, we have to move everything with Brinks trucks. We have to pay for there's the custody, delivery, and and it's also the first and only fund like this. So you can charge a little more. We had to incentivize a partner to provide their services, which is Horizon Kinetics, and all the other expenses. Whenever someone does something for the first time, these funds generally start at 2%. GBTC is a good example. That was a 2% fund. But yes, I do envision that fee going down. In fact, I think this is a forward expectation. So who knows? But in a most likely scenario, this fund actually gets acquired by or becomes the ETF, and in which case the expenses go down, the scale goes up. We also don't know how big this fund will be. So there's a lot of upfront costs that we have to cover. But I do want to bring that fee down to the extent we can.
Daniel La Jolla says, the diamonds in the bars and coins are encapsulated. Don't need to go into detail, but is there a process to safely remove the diamonds for liquidity back into the jewelry market?
Yes, we designed it with that. All you do is you drop the coin or bar in paint thinner that you can buy in any hardware store, and it can take 24 to 48 hours, but the coin will dissolve and the diamonds will have no damage whatsoever. It also destroys the computer chip, which we don't want it to be off on its own. But yes, all you do is drop the coin in a paint thinner, and you then have 8 GIA certified diamonds. You can put them in a bracelet or a necklace, but I have to warn you, the diamonds aren't matched. So when you go to Tiffany's and you buy a bracelet, those diamonds all match. They're calibrated size and clarity and color. These diamonds by design are a statistical sample of all diamonds. So you always have a yield curve in every bar or every coin where they go from small, medium, and large. They have colorless, mid, and mediocre color, etc. So you don't have a good set. And what you introduce is friction. That's the whole problem with diamonds. If you break up a bar and try to sell the diamonds individually, you have tremendous friction, because now you have to find somebody who wants those 8 loose diamonds. They're going to say what I just said, these don't match, and they're going to lowball you on the price. So I wouldn't recommend it unless you're actually going to put them in a piece of jewelry yourself. You'd be better off selling the commodity at the market price, and you're not going to lose 40%, the way you do if you buy a ring and try to sell that.
From Paul Newhausen, is the diamond standard coin considered a stable coin?
No, stablecoin I think is a dirty word lately, especially if you look at Terra and Luna, they weren't stable at all. It's a commodity coin, and it's really an important breakthrough because a commodity is not a security, and a stablecoin really is. If you look at Tether is a unlicensed bank running a unregulated money market fund selling unregistered shares that they call tethers. That's violating the securities laws 3 ways. And at any moment, the SEC could cause Tether to rescind its offering. That's generally the remedy, is to rescind the offering because it cannot be remedied otherwise. So, but a commodity coin is different. It's not a security. It's not a share. You have this. When you own the token that's part of this, you can actually go to Brinks and you can say, give me the coin, and they'll put it in your hand. And it's that like kind exchange. You can always convert the token into the commodity. That means that the token itself is a commodity, or at least it cannot be considered a security. You don't have a share. You don't have a pool. You have a deliverable asset. And maybe I'll mention that because I didn't before, because some people might not be familiar. But inside every diamond standard coin, you see that white layer, and you can see it from the back easily. That's a wireless computer chip that's built in with the diamonds. And that chip provides auditing, for example. While these are at Brinks or JP Morgan, if you're an institution, you can audit that this is really there. You can talk to it. Also, if I hand this to you in Switzerland, you can break out your phone and you can analyze that chip. And you can you take a picture of it to validate the pattern. There's always a fingerprint. But with your phone, you can be 100% certain if the coin is real. But the most important feature of the chip is that it stores a blockchain token. And Diamond Standard has the world's only regulatory license for a commodity token. What that means is you and I can trade that token while it's sitting in a vault. If it's sitting in your sock drawer, you can't trade it because there's no one to enforce delivery. But if this is sitting in Brinks, somebody else can buy the token, and that token is the receipt that they can give to Brinks, and Brinks will give them the coin. That token is what is held by the fund. It's what's delivered with the futures contract. When you settle the futures contract, you deliver 20 tokens to the futures broker, and they know if they needed to, they could get the coin from the vault. What that means is this is what's called a smart commodity because it's both physical and digital. That digital, because it's blockchain native, it's an ERC20 token, that token can be attached to a smart contract. You can take a loan against it from some of these online banks. You can transact it extremely efficiently and instantly. And we think that creates a network effect where this same asset can transform into a spot trade, into a futures contract settlement, into an ETF basket very, very instantaneously and electronically. So that's the other aspect I didn't really mention.
Once the fund is live and eventually the ETF, is the value of owning the coin or bar going to go away? There would no longer be a need to buy a coin or bar to own diamonds as an asset, and does it remove the value of the blockchain token?
Well, it's just like gold. The vast majority of investors who allocate to gold, they just buy GLD because it's part of their investment statements. It's custodied with all their other investments. Brokers can distribute it with no problem. But there's always some people that hold physical gold. Gold bugs are a good example, but there's always demand for gold. And for these assets, that gold has to exist. It has to be in a vault somewhere. It has to be audited, authenticated, and sometimes moved. So we think that the value of the asset will always be present. And we think the tokens will have a secondary use beyond just transacting this asset, which is those tokens are unique because they are physical and digital. We think that they can support a new kind of digital currency that we're launching. It's called Bitcarbon. You see it on the back of every coin. And Bitcarbon will be a multi-chain asset-backed digital currency or commodity coin that can be transacted and used as a payment mechanism or store of wealth that should hopefully, it will reflect the value of the commodity. Because if you have Bitcarbons, you can always convert them back into a coin if the value ever disassociates.
I believe that that's all of the questions. I did want to mention that this webinar has been recorded, and everybody that is signed up and registered here will receive a recording as a follow-up. And if there is interest in seeing the presentation that Cormac presented here, please just reply to chris@diamondstandard.co and we can provide you with a copy of that presentation. Also, the fund, if you want to register at the fund, we are accepting registration where you can confirm your accreditation and KYC status at fund.diamondstandard.co.
Great. Thank you, everybody.